After enough decades watching this country rise, stumble, improvise, and ultimately keep moving forward, you start to appreciate just how much of America's story is really about confidence. Not bravado, just that quiet, sturdy belief that tomorrow will be a little better than today, that people will show up to work, that the rule book still works, and that the institutions we inherited are strong enough to outlast any one of us. I've been investing for over 70 years now, and I've seen this pattern repeat itself more times than I can count. I've watched markets panic over headlines that disappeared in a week, and I've seen them shrug off things that seemed monumental at the time. The Cuban Missile Crisis, Vietnam, Watergate, the savings and loan crisis, 9/11, the financial meltdown of 2008 each time. People wondered if this was finally the moment America would break. But at the heart of it all, it's always been the same engine, people deciding whether they trust the system or not. When I started at Columbia Business School in 1951, studying under Ben Graham, America was still finding its footing after World War II. The country had emerged victorious, yes, but there was genuine uncertainty about what kind of nation we would become. Would we retreat into isolationism? Would the economic boom last? Could our institutions handle the complexities of being a global superpower? Benjamin Graham taught me something that has guided my entire investment philosophy. The market is a voting machine in the short run, but a weighing machine in the long run. What he meant was that day to day, markets reflect emotion, fear, greed, and speculation. But over time, they reflect the underlying fundamentals, the real value of what we're building together as a society. That lesson applies far beyond investing. America itself is both a voting machine and a weighing machine. In moments of crisis, we vote with our emotions, we panic, we overreact, we assume the worst. But over the decades, the country weighs what really matters: our capacity for innovation, our willingness to adapt, our ability to self-correct. I've seen markets panic over headlines that disappeared in a week, and I've seen them shrug off things that seemed monumental at the time. The Khrushchev shoe-banging incident at the UN in 1960 that felt like the world was ending, the inflation of the 1,970 seconds, when people genuinely wondered if the dollar would become worthless. The dot-com crash, when it seemed like we had all been living in a fantasy, but each time something fundamental reasserted itself. People got back to work. Entrepreneurs found new solutions. Institutions bent but didn't break. And investors who kept their heads while others were losing theirs, well, they did quite well for themselves. Leadership shapes that trust often more by tone than by policy. I've had the privilege of knowing several presidents personally, from Ronald Reagan to Barack Obama, and what strikes me is how much their effectiveness depends not on their specific policies, but on their ability to project calm competence. Reagan had a gift for making Americans feel optimistic about themselves, even during difficult times. Obama could convey thoughtfulness and deliberation when the country needed to feel that someone was carefully considering all angles. Institutions, military, political, economic, sometimes move like glaciers and sometimes like frightened cats, depending on the mood of the nation. The Federal Reserve, for instance, has made plenty of mistakes over the decades. But what's remarkable is its ability to learn, adapt, and maintain credibility even after significant errors. Paul Volcker's decision to accept a brutal recession in the early 1,980 seconds to break the back of inflation was deeply unpopular at the time, but it restored faith in the institution's willingness to make hard choices. And if you live long enough, you see how viral moments, the kind that explode across everyone's screens in seconds, often reveal as much about our collective nerves as they do about the person speaking. I remember when President Kennedy appeared on television during the Cuban Missile Crisis. There was no social media then, no instant commentary, but the country still held its breath. The difference now is that every word, every gesture, every pause gets dissected and amplified 1,000-fold before the speaker has even finished their sentence. That's the grand picture, the long arc. The perspective that comes from watching storms come and go. When you're 94 years old, You've seen enough cycles to know that what feels permanent in the moment is often just a passing phase. Now, I don't think anyone would argue that the country's been in a period of tension lately. The markets have been jittery, Washington's been unusually loud, and every institution seems to be under a kind of atmospheric pressure you can't quite see but absolutely feel. I've been through enough market cycles to recognize the signs. It's not just the numbers on the screen, though those certainly tell part of the story. The VIX has been elevated, bond yields have been volatile, and you can see uncertainty priced into everything from currency hedges to the way corporations are structuring their capital investments. But the real indicator is more subtle. It's in the way CEOs talk during earnings calls, hedging their language more than usual. It's in the way congressional leaders frame their statements, always with one eye on how their words might be interpreted by markets. It's in the way ordinary families discuss their financial planning with a little more worry, a little less assumption that next year will naturally be better than this year. Investors sense it. I see it in the questions I get at Berkshire Hathaway shareholder meetings, in the letters people write to me, in the conversations I have with other business leaders. There's a quality of attention that's different, sharper, more vigilant. People are listening more carefully to signals they might have ignored in calmer times. Policymakers sense it too. I've been to enough meetings in Washington over the years to recognize when the usual political theater gives way to genuine concern. Lately, there's been less grandstanding and more genuine worry about the fragility of public confidence. Republicans and Democrats may disagree on solutions, but there's a bipartisan recognition that the country is in one of those delicate moments where words matter more than usual. Ordinary families sense it most of all. They may not follow the daily fluctuations of the stock market or parse the language of Federal Reserve statements, but they feel it in grocery store prices, in conversations with their neighbors, in the tone of news coverage. They're making decisions about major purchases, about career changes, about retirement planning with less certainty than they would have felt just a few years ago. Confidence behaves like a flock of birds, one sharp noise, and suddenly the whole sky moves. I learned this lesson early in my investing career. In 1962, President Kennedy confronted U.S. steel over a price increase, and the market dropped sharply on fears of government intervention in private business. The fundamentals of American companies hadn't changed overnight, but the perception of the relationship between government and business had shifted, and that was enough to send capital fleeing. And when confidence wavers, markets don't wait for the details. They start pricing the uncertainty immediately. This is both rational and irrational. Rational because uncertainty genuinely does create costs. Companies delay investments, consumers postpone purchases, international partners hedge their bets. Irrational because the market's reaction often exceeds what the actual policy changes would justify. I've seen this pattern dozens of times. In 1979, when Paul Volcker raised interest rates dramatically, the market initially panicked. Investors couldn't see past the immediate pain to the long-term benefit of wringing inflation out of the system. In 1994, when the Federal Reserve began a series of rate hikes, many predicted economic catastrophe. In both cases, the initial fear proved overblown, but the fear itself created real economic effects in the short term. So when we talk about tariffs, trade shifts, or major economic announcements, we're not just talking about policy. We're talking about signals that ripple through corporate planning, household expectations, and the broader sense of national steadiness. A tariff isn't just a tax on imports. It's a statement about how America sees its relationship with the world. A trade negotiation isn't just about specific products and percentages. It's about whether other countries can count on American policy to be stable and predictable. An economic announcement isn't just about immediate impacts. It's about what kind of country we think we're building together. Before the viral moment hit, that was the backdrop. A country leaning forward in its chair, anticipating the next tremor. Financial markets trading on every rumor and half statement. Corporate boardrooms gaming out multiple scenarios. International partners watching American domestic politics more carefully than they watch their own. It's like the economy had developed a kind of hypersensitivity, not unhealthily so, but aware that we were in one of those periods where small moves could have large consequences. And into this environment stepped the central figure of the moment, President Donald Trump. Now, You can say many things about him, people certainly do, but one thing that's clear is that he's been a consequential public figure whose statements tend to carry outsized weight. Whether you agree with his approach or not, markets, institutions, and foreign observers pay attention. I've been observing public figures for 9 decades now, and Trump represents something genuinely unusual in American political life. Most politicians, even very successful ones, spend their careers learning to modulate their language, to speak in ways that can be interpreted multiple ways by different audiences. It's a skill, the ability to say something meaningful without saying something that can be easily turned against you. Trump operates differently. He speaks in definitive terms, makes broad pronouncements, and seems relatively unconcerned with how his words might be parsed by various constituencies. This approach has obvious political benefits. It projects confidence and decisiveness, but it also means that his statements carry a different kind of market weight than we're accustomed to. He's someone with decades of public presence, a businessman turned commander-in-chief, accustomed to headlines and accustomed to shaping them. I knew Donald slightly in the 1,980 seconds and 1,990 seconds, when he was primarily known as a real estate developer and casino owner. Even then, he had an unusual relationship with publicity. Most business leaders try to stay out of the newspapers unless they're announcing good news. But Donald seemed to understand instinctively that attention itself could be a business asset. When he entered politics, he brought that same approach, the understanding that capturing attention is often more important than crafting the perfect policy paper. This has served him well politically, but it creates a unique dynamic for markets and institutions that are used to more predictable patterns of communication. What makes this particularly significant is that Trump's base of support includes many people who feel that traditional institutions have not served their interests well. So when he speaks, he's not just communicating policy preferences. He's often signaling a broader skepticism about established ways of doing things. This can be healthy. Institutions do need periodic challenges to remain vibrant, but it also means that his words carry implications beyond their immediate content. International observers have had to recalibrate how they interpret American policy signals. For 70 years after World War II, there was a general expectation that American foreign economic policy would change incrementally with plenty of advance warning and consultation with allies. Trump's approach has been more improvisational, which has forced other countries to maintain higher levels of alertness and develop more flexible contingency plans. And because tariffs are deeply tied to global trade flows, inflation, supply chains, and geopolitical positioning, whenever he speaks on the subject, well, people lean in, they listen, they react. Tariffs aren't just technical policy tools, they're expressions of how a country sees its place in the world. When America raises tariffs, it's making a statement about self-reliance, about the value of domestic production, about the terms on which we're willing to engage with international partners. These are profound questions that go to the heart of what kind of economy we want to build. I've lived through several major shifts in American trade policy. In the 1,960 seconds and 1,970 seconds, the consensus was strongly in favor of free trade, based on the theory that comparative advantage would benefit everyone. In the 1,980 seconds, that confidence was shaken by Japanese competition in automobiles and electronics, leading to voluntary export restraints and other measures that were essentially managed trade. In the 1,990 seconds, NAFTA and the creation of the WTO represented a renewed commitment to opening markets. Each of these shifts reflected not just economic analysis, but deeper questions about American identity and capabilities. Are we confident enough in our workers and companies to compete on a level playing field? Do we see international economic integration as an opportunity or a threat? How do we balance the interests of consumers who benefit from low prices with the interests of workers who may be displaced by foreign competition? These are legitimate questions, and reasonable people can disagree about the answers. But when they're debated in the context of heightened political tension, with social media amplifying every statement, the discussion can quickly move from policy analysis to something more like tribal identification. That's the gravity of the situation. His words don't float in isolation. They land inside a system already tuned to react to every signal. When President Trump makes a statement about tariffs, it immediately gets filtered through multiple interpretative frameworks. What does this mean for the stock market? How will China respond? What does this tell us about the administration's broader economic philosophy? How will this affect the upcoming election? In calmer times, a policy announcement might be assessed primarily on its own merits. But in moments of heightened attention, every statement becomes a Rorschach test, with different observers seeing confirmation of their existing beliefs and fears. Then came the spark, a simple statement, an outline of proposed new tariffs, a line suggesting sweeping increases, framed as a way to rebalance trade and strengthen American industry, calmly delivered, almost matter of fact. That was it. I wasn't in the room when the statement was made, but I've been around enough consequential announcements to know that the speaker probably didn't anticipate the scale of reaction that would follow. Most policy statements are designed to communicate with specific audiences, congressional leaders, industry representatives, international counterparts. But in our current media environment, every statement is potentially a global broadcast. The specific details matter less than the pattern. Trump announced tariffs of 25% on goods from Mexico and Canada, along with additional tariffs on Chinese imports. The economic rationale was straightforward. Use trade policy as leverage to address immigration and drug trafficking issues, while also protecting American manufacturing jobs. From a policy perspective, this represented a significant expansion of tariff use beyond traditional trade concerns. Historically, tariffs have been imposed primarily for economic reasons, to protect domestic industries or to retaliate against unfair trading practices. Using them as leverage for immigration and security policy represented a broader interpretation of presidential trade authority. The announcement was made via social media, which has become the administration's preferred communication channel for major policy shifts. This approach has advantages. It allows for direct communication without media interpretation, but it also means that complex policy changes get compressed into formats designed for quick consumption rather than careful analysis. But once the clip hit the online bloodstream, social media did what social media always does: exaggerated, amplified, sliced away context, and packaged the moment into something far louder than the original tone. I've watched this transformation happen countless times over the past decade. A measured statement gets posted online, then gets shared with increasingly dramatic commentary. Trump announces massive tariffs. Market alert. New trade war begins. Economic disaster. Tariffs will destroy American economy. Each share adds another layer of interpretation, another degree of emotional intensity. By the time the statement has made its way through multiple rounds of social media amplification, it bears little resemblance to the original tone or content. The speed of this transformation is remarkable. Within minutes of the original post, financial news services had published analysis pieces. Within an hour, international media outlets were running stories about American trade policy chaos. Within a day, the statement had been translated into dozens of languages and was being debated in parliaments and boardrooms around the world. Suddenly you had headlines declaring economic catastrophe, claims that these tariffs would ruin America's economy, predictions of immediate fallout, declarations of defiance, interpretations of loyalty tests, and counter-interpretations of patriotism. The economic predictions range from measured analysis to outright panic. Some economists warned that broad-based tariffs could reignite inflation just as it seemed to be coming under control. Others pointed out that tariff increases often lead to retaliatory measures, potentially escalating into broader trade wars. A few noted that the proposed tariffs might violate existing trade agreements, creating legal as well as economic complications, but mixed in with legitimate economic analysis were much more dramatic claims. Social media filled up with posts suggesting that the tariffs would immediately crash the stock market, destroy American consumers' purchasing power, and fundamentally alter America's relationships with its closest allies. The political interpretations were equally varied. Some saw the tariffs as a brilliant negotiating tactic, a way to get attention from trading partners who might have been ignoring more conventional diplomatic approaches. Others viewed them as a dangerous escalation that could undermine carefully constructed international relationships. What was particularly striking was how quickly the discussion moved from policy analysis to identity politics. Supporting or opposing the tariffs became a way of signaling broader political loyalties rather than technical economic judgments, all from a short, steady remark. The calmness, paradoxically, is what made it dramatic. People projected their own anxieties onto it. A quiet phrase became a national storyline. I've noticed this pattern before. Some of the most consequential moments in American history have been marked not by dramatic rhetoric, but by understated statements that carried enormous weight because of their context. When President Eisenhower announced the federal intervention in Little Rock Central High School, his tone was measured and institutional. When President Kennedy announced the naval blockade during the Cuban Missile Crisis, he spoke calmly and deliberately. When President Nixon announced his resignation, his voice was controlled and formal. In each case, the restraint made the moment more powerful, not less. People understood that they were witnessing something historically significant precisely because the speaker was maintaining composure under extraordinary pressure. Trump's calm delivery of the tariff announcement had a similar effect. In a political environment where dramatic rhetoric has become routine, the matter-of-fact tone suggested that this wasn't political theater, this was actual policy. And that realization, more than the specific details of the tariffs themselves, is what sent shockwaves through the system. When something like that travels so fast, it tells you more about public mood than about the policy itself. The speed and intensity of the reaction revealed just how much anxiety was already present in the system, waiting for a catalyst. Markets are like a sensitive barometer. They don't wait for the weather report. They react to the change in pressure. Tariffs in investor psychology represent uncertainty, supply chain adjustments, retaliatory measures, input costs, inflationary ripple effects. I've been watching markets react to policy announcements for 7 decades, and there are certain patterns that repeat themselves with remarkable consistency. First, there's the immediate knee-jerk reaction, usually an overreaction in whichever direction the news seems to point. Then there's a period of analysis and recalibration as people dig into the details. Finally, there's a longer-term adjustment as the actual policy effects become clear. In this case, the immediate market reaction was sharp, but not entirely surprising. The dollar strengthened against the Mexican peso and Canadian dollar, reflecting expectations that tariffs would reduce imports from those countries. Stock prices for companies with significant exposure to cross-border trade fell, while domestic manufacturers saw modest gains. But the broader market reaction was more complex. Investors had to weigh several competing factors. Would the tariffs succeed in changing behavior by Mexico and Canada, potentially resolving the issues that prompted them? Would they lead to retaliatory tariffs that could harm American exporters? Would they contribute to inflation, potentially forcing the Federal Reserve to reconsider its monetary policy? These aren't questions that can be answered immediately, which is why markets struggle to find a clear direction. When investors can't calculate probabilities with confidence, they tend to demand higher risk premiums, which shows up as increased volatility and often lower overall asset prices. The international dimension added another layer of complexity. Currency markets had to factor in not just the immediate trade effects, but also the broader implications for American relationships with its major trading partners. If the tariffs led to a sustained period of trade tension, that could affect everything from tourism flows to investment patterns to diplomatic cooperation on unrelated issues. But the viral reaction, the claim that such tariffs would ruin the economy, that's something different. That's narrative contagion. I learned about narrative contagion from Robert Shiller, the Yale economist who won the Nobel Prize for his work on behavioral finance. The basic idea is that economic outcomes are influenced not just by objective factors like productivity and resource allocation, but also by the stories people tell themselves about what's happening and what's likely to happen next. When a particularly compelling narrative takes hold, it can become self-fulfilling. If enough people believe that tariffs will cause economic catastrophe, they'll change their behavior in ways that make economic problems more likely. Companies will delay investments, consumers will postpone purchases, and investors will demand higher returns to compensate for perceived risks. The viral nature of social media amplifies this effect enormously. In previous eras, it might have taken weeks or months for a particular economic narrative to spread widely enough to affect behavior. Now, it can happen in hours, with millions of people simultaneously receiving the same interpretation of events and adjusting their expectations accordingly. This creates a kind of economic instability that's different from anything we've seen before. It's not based on changes in underlying economic fundamentals, but on the speed with which perceptions can shift and spread. Markets that might have absorbed a policy change gradually over time instead experience sudden, synchronized shifts in sentiment. In finance, we talk about volatility spikes, not because fundamentals changed, but because sentiment did. A sudden jolt of fear, a search for meaning. I've seen this pattern many times over the years. In 1987, the stock market crashed not because of any single piece of news, but because computerized trading programs created a feedback loop that accelerated selling. In 1998, the collapse of long-term capital management created fears about the stability of the entire financial system, even though the fund represented a tiny fraction of total financial assets. In 2008, the failure of Lehman Brothers triggered a global panic that went far beyond what the bank's actual economic importance would have justified. In each case, the market reaction was driven not just by the immediate facts, but by stories about what those facts might mean for the future. And those stories, once they gained momentum, became powerful enough to influence the very reality they purported to describe. The tariff announcement triggered a similar dynamic. The actual economic effects of the proposed tariffs, while significant, weren't large enough to justify predictions of economic catastrophe. But the story that developed around the tariffs, that they represented a fundamental shift toward protectionism that could unravel decades of economic integration, was powerful enough to move markets and change behavior even before any tariffs were actually implemented. Foreign observers watch these signals too. Tariff talk isn't just economic policy, it's a geopolitical broadcast. And every word, every tone shapes their interpretation of American steadiness. When I travel internationally, which I still do occasionally at my age, I'm always struck by how closely other countries follow American domestic politics. What we might see as routine political maneuvering, they interpret as signals about America's long-term reliability as a partner and leader. The tariff announcement was particularly significant from this perspective because it touched on relationships with Canada and Mexico, America's closest allies and largest trading partners. If the United States was willing to use tariffs as leverage against its most reliable partners, what did that suggest about American commitments to other countries? European leaders, Asian allies, and international institutions all had to recalibrate their assumptions about American predictability. This doesn't necessarily mean they viewed the tariffs as wrong or right, but they had to factor in a higher degree of uncertainty about future American policy moves. That uncertainty has costs. When countries can't predict American policy with confidence, they invest more resources in hedging strategies and alternative partnerships. They diversify their trade relationships, build redundant supply chains, and maintain larger financial reserves. All of these are rational responses to uncertainty, but they also represent economic inefficiencies that reduce overall global prosperity. Leadership creates confidence or volatility. And in markets, confidence is the most precious commodity we have. This is something I've learned over many decades of investing. The most successful investments aren't necessarily in companies with the best products or the most brilliant strategies. They're in companies that people trust, companies that communicate clearly, deliver on their promises, and maintain consistent approaches even when facing challenges. The same principle applies to countries. Economic growth depends on millions of people making long-term commitments, starting businesses, acquiring skills, building relationships, investing in infrastructure. Those commitments require confidence that the basic rules of the game will remain stable enough to make long-term planning possible. When that confidence wavers, the effects ripple through every aspect of the economy. Companies postpone expansion plans, workers delay career moves, investors demand higher returns, and international partners hedge their bets. None of these individual decisions may seem significant, but collectively they can slow economic growth and reduce living standards for everyone. Political leaders, whether they realize it or not, are in the confidence business. Their most important job isn't necessarily to make the perfect policy decisions, but to convince people that the system is stable, predictable, and worthy of long-term commitment. And this didn't happen in a vacuum. It hit the internet at a moment when people were already discussing rising prices, supply chain fragility, questions of institutional independence, debates about global competition, and the general sense that the world's economic order was shifting. I've lived through enough historical moments to recognize when the country is in one of those transitional periods when the assumptions that have guided us for decades suddenly seem less certain, and we're forced to reconsider fundamental questions about how our society works. The last few years have been full of these kinds of challenges. The COVID-19 pandemic disrupted supply chains and forced us to confront our dependence on international production networks. The inflation of 2021 and 2022 reminded us that price stability, which we had taken for granted for decades, isn't automatically guaranteed. The war in Ukraine highlighted our connections to global energy and food systems. The rise of China forced us to reconsider assumptions about trade and technological competition. Each of these challenges individually might have been manageable, but coming in rapid succession, they created a sense that the post-Cold War era of American dominance and global stability was coming to an end, and we weren't sure what would replace it. Recent retirements in key agencies added to this sense of institutional transition. When experienced civil servants retire or leave government service, they take with them decades of institutional knowledge and relationships. This isn't necessarily a crisis. All institutions need periodic renewal, but it does create a temporary reduction in predictability as new people learn their roles and establish their credibility. Statements from lawmakers that seem to push institutions closer to politics heighten concerns about institutional independence. The Federal Reserve, the Justice Department, the military, and other key institutions have traditionally maintained some distance from day-to-day political battles. When that distance seems to be shrinking, it raises questions about whether these institutions will be able to maintain public trust across different political administrations. Viral videos of everyday Americans expressing frustration about costs and wages gave voice to economic anxieties that weren't always captured in official statistics. The unemployment rate might be low and GDP growth might be positive, but many people felt that their personal economic situation was becoming more precarious, not more secure. International partners making their own adjustments reflected a broader global trend away from the assumption that American leadership would always be available to resolve international problems. This wasn't necessarily anti-American sentiment, but rather a realistic recognition that America was dealing with its own internal challenges and might have less bandwidth for international problem solving. When all of that is already in the air, a tariff announcement isn't just a policy remark. It feels like another weight added to a shelf that people worry might already be buckling. I remember similar moments from earlier decades. In the late 1970s, there was a pervasive sense that American power was declining. The Vietnam War had ended badly. The economy was struggling with stagflation. The Iran hostage crisis had made America look helpless on the international stage. President Carter spoke of a national malaise, though he never actually used that word. People worried that America's best days were behind it. In the late 1980s, there were widespread concerns that America was losing economic ground to Japan. Japanese companies were buying iconic American properties like Rockefeller Center. Japanese manufacturing methods were being studied and copied by American companies. And there were genuine fears that America might become a second-rate economic power. Books like The Rise and Fall of the Great Powers became bestsellers by arguing that America was following the same path as previous dominant nations. In both cases, the anxiety was real and the challenges were genuine. But both times, America proved more resilient and adaptable than the pessimists predicted. The economy recovered from stagflation. American technological innovation reasserted itself, and new sources of strength emerged that hadn't been anticipated by the forecasters of decline. What I learned from those experiences is that moments of national anxiety often precede periods of renewal and growth. When people are worried about the future, they're more likely to question existing assumptions, experiment with new approaches, and make the kinds of changes that strengthen the country over the long term. But in the short term, these moments of transition can be genuinely unsettling. Moments accumulate, narratives multiply, anxiety compounds. People start looking for patterns and meaning in events that might otherwise seem routine. A policy announcement becomes a symbol of broader trends. A market movement becomes evidence of fundamental problems. A political statement becomes a test of institutional stability. And investors, well, they price all of that in real time. This is what makes investing during periods of transition so challenging. The traditional tools of financial analysis assume a certain degree of stability in underlying institutions and relationships, But when those foundations are shifting, historical patterns become less reliable guides to future performance. I've always told investors to focus on companies with strong competitive advantages and competent management, because those are the businesses most likely to thrive regardless of external circumstances. But even the strongest companies can struggle when the broader economic and political environment becomes unpredictable. During these periods, the most important investment skill isn't technical analysis or financial modeling, it's judgment about the underlying resilience of American institutions and the American people. Can we adapt to new challenges? Will we find ways to maintain cooperation even amid political disagreement? Do we still have the capacity for the kind of long-term thinking that built our prosperity in the first place? Those aren't questions that can be answered with data and spreadsheets. They require a kind of faith, not blind faith, but informed confidence based on historical experience and understanding of American character. But if you've lived long enough, you also learn something simpler. We've been here before. America has weathered greater storms than any tariff proposal. We've endured wars that strained every institution we have. We've lived through Watergate, which nearly melted public trust. We've climbed out of depressions and financial crises when people genuinely wondered whether the system would hold. I was born in 1930, just as the Great Depression was beginning. My earliest memories are of a country that was genuinely uncertain about its future. Unemployment reached 25%, banks failed by the thousands, farmers lost their land. Entire communities were uprooted as people searched for work that didn't exist. But even in those desperate circumstances, something remarkable happened. Americans didn't abandon their institutions, they renovated them. The New Deal created Social Security, federal deposit insurance, securities regulation, and dozens of other programs that strengthened the country's foundation for decades to come. People didn't lose faith in democracy, they demanded that it work better. I was in high school during World War II when America faced an existential threat from powerful enemies on two fronts. The country mobilized resources on a scale that would be difficult to imagine today, rationing basic consumer goods, converting factories from civilian to military production, asking families to sacrifice their sons and fathers for uncertain victory against formidable opponents. But the war also demonstrated American capacity for innovation and cooperation under pressure. We developed new technologies, forged new alliances, and discovered organizational capabilities we didn't know we possessed. The country that emerged from the war was not just victorious, but fundamentally stronger and more confident than the one that had entered it. I was starting my investment career during the Cold War, when Americans lived with the constant possibility of nuclear annihilation. For decades, we maintained alert forces, built fallout shelters, and conducted air raid drills based on the assumption that civilization itself might end without warning. Children practiced hiding under their school desks, and families stockpiled supplies in their basements. Yet even under that existential pressure, America continued to invest in the future. We built the interstate highway system, expanded higher education, funded basic scientific research, and created the conditions for the longest period of sustained prosperity in human history. We didn't allow fear of destruction to prevent us from building. I've been through multiple economic crises that seemed world-ending at the time, but proved to be temporary setbacks. The 1973 to 1974 recession, triggered by the oil embargo, felt like a fundamental challenge to American industrial power. The inflation of the late 1970s made people wonder whether the dollar would retain any value at all. The savings and loan crisis of the late 1980s raised questions about the stability of the entire financial system. Each time, there were respected voices predicting that this crisis would be the one that finally overwhelmed America's capacity for recovery. Each time, the combination of institutional resilience, individual innovation, and democratic responsiveness proved stronger than the temporary challenges. What you see again and again is that institutions don't fail all at once. They bend, they wobble, they creak in the wind. But they also recover because individuals inside them choose duty over noise. The Federal Reserve has made plenty of mistakes over the decades, but it has also learned from those mistakes and retained the confidence of financial markets. The Supreme Court has issued decisions that were deeply unpopular at the time, but it has maintained its role as the final arbiter of constitutional questions. Congress has been paralyzed by partisanship repeatedly, but it has also found ways to address national challenges when the stakes were high enough. These institutions survive not because they're perfect, but because they're operated by people who understand that their individual careers are less important than the long-term health of the country. Even when political pressures push toward short-term thinking, there are usually enough people in key positions who take a longer view. I've had the privilege of knowing many of these people over the years, Federal Reserve governors who made unpopular decisions because they were economically necessary, military leaders who gave honest assessments even when they contradicted political preferences, business leaders who took stands that hurt their short-term interests but served the broader public good. These individuals don't usually get much public recognition, and they often pay personal costs for their principled decisions. But they're the reason American institutions have been able to maintain credibility through multiple crises that might have destroyed less resilient systems. Policies come and go, leaders rise and retire, but the long arc of American economic resilience is astonishingly steady when you zoom out far enough. I like to remind people that someone who invested $10,000 in the S&P 500 inches 1,942 right after Pearl Harbor, when America's prospects looked quite uncertain, would have seen that investment grow to over $50 million by 2024, even after accounting for inflation. That's not because every year was good or every policy was wise, but because the underlying fundamentals of American economic growth have proven remarkably durable. The country has faced depressions, recessions, wars, political scandals, natural disasters, technological disruptions, and social upheavals. Through all of it, the basic mechanisms of American prosperity, innovation, competition, rule of law, property rights, and democratic accountability have continued to function. This doesn't mean that America is guaranteed to succeed forever or that current challenges aren't serious, but it does suggest that we have institutional and cultural resources for dealing with difficulties that are deeper and more robust than they sometimes appear in moments of crisis. The key is remembering that America's strength has never been its perfection, but its capacity for self-correction. When something isn't working, we usually find ways to fix it. When new challenges emerge, we usually develop new capabilities to address them. When trust is damaged, we usually find ways to rebuild it. It's human to interpret a moment through emotion. Most people saw only a clip, not the context, and they reacted not to what was said, but to what they feared it might mean. That's human nature. I've been studying human behavior, both in markets and in life, for 9 decades now. One thing I've learned is that people are remarkably consistent in how they process information, especially when they're feeling uncertain or anxious. We tend to focus on whatever confirms our existing beliefs. We tend to assume that current trends will continue indefinitely, and we tend to interpret ambiguous information in ways that validate our fears. This isn't a character flaw, it's an evolutionary adaptation. For most of human history, it was safer to assume that rustling in the bushes might be a predator than to assume it was just the wind. The cost of being wrong about danger was much higher than the cost of being wrong about safety. So we developed mental habits that prioritize threat detection over careful analysis. Those same mental habits shape how we respond to economic and political information. When people are already feeling anxious about the future, they're naturally inclined to interpret new information as confirmation that their anxieties are justified. A policy announcement becomes evidence of impending catastrophe, a market decline becomes proof of systemic failure, a political statement becomes a sign of institutional collapse. Markets behave the same way, just with dollar signs attached. This is what Benjamin Graham meant when he described the market as a voting machine in the short run. Daily price movements reflect the collective emotions of millions of investors, each trying to guess what other investors are thinking and feeling. Fear feeds on fear, optimism breeds optimism, and objective analysis often gets overwhelmed by psychological momentum. I've seen this pattern countless times over the decades. In 1962, President Kennedy's confrontation with U.S. steel over price increases triggered a sharp market decline, not because steel prices were fundamentally important to most companies, but because investors feared government interference in private business. In 1987, the market crashed on Black Monday without any specific piece of bad news, just a general sense that prices had risen too far too fast. In 1999, internet stocks soared to absurd valuations because investors convinced themselves that traditional measures of value no longer applied. In each case, the market was reacting not to objective changes in economic fundamentals, but to shifts in collective psychology. And those psychological shifts, while temporary, could have real economic effects while they lasted. The viral reaction to the tariff announcement followed a similar pattern. The actual policy implications of the tariffs were significant but manageable, the kind of trade adjustment that the American economy has absorbed many times before. But the symbolic implications felt much larger because people projected their broader anxieties about American competitiveness, political stability, and international relationships onto this single announcement. Interpretation drives action, fear exaggerates, calm steadiness anchors. This is why I've always tried to make investment decisions based on long-term fundamentals rather than short-term market psychology. When everyone else is panicking, that's often the best time to buy. When everyone else is euphoric, that's often the best time to sell. Not because I'm smarter than other investors, but because I try to focus on what companies are actually worth rather than what other people think they might be worth next week. The same principle applies to thinking about the country. When everyone is predicting disaster, it's worth asking whether the fundamental sources of American strength have actually changed, or whether we're just going through one of those periodic moments of collective anxiety that feel overwhelming but prove temporary. The fundamental sources of American economic strength, our rule of law, our educational system, our capacity for innovation, our geographic advantages, our cultural diversity, haven't disappeared overnight. They may need updating and improvement, but they're still there, still functioning, still creating opportunities for people who are willing to work hard and think creatively. What changes more rapidly is our collective confidence in those fundamental strengths. Sometimes we feel optimistic about our capabilities. Sometimes we feel pessimistic. But the capabilities themselves are more stable than our feelings about them. Tariffs are concrete policy. But the viral reaction was about psychology, about a country trying to figure out whether it still trusts the system to absorb shocks without breaking. This gets to the heart of what I think is happening in America right now. We're not primarily facing an economic crisis or a political crisis, though we certainly have economic and political challenges. We're facing a crisis of confidence, uncertainty about whether our institutions, our relationships, and our basic approach to solving problems are still adequate for the challenges we face. That kind of confidence crisis can become self-fulfilling if it persists long enough. When people lose faith in institutions, those institutions do become less effective. When people lose trust in each other, cooperation becomes more difficult. When people lose hope in the future, they stop making the investments in education, research, and infrastructure that actually create a better future. But confidence crises can also be resolved relatively quickly if the right kind of leadership emerges. Leadership that demonstrates competence, maintains steady nerves under pressure, and helps people remember what they have in common rather than what divides them. And here's the part that always interests me. Tone becomes symbolism. The president's tone wasn't loud, confrontational, or dramatic. It was measured. But in a tense moment, that quietness read as something larger. People read meaning into the stillness. Some saw reassurance. Others saw provocation. I've noticed this pattern throughout American history. Some of our most consequential leaders have been those who could project calm competence during moments of crisis. George Washington's farewell address was notable not for dramatic rhetoric, but for its measured assessment of the challenges facing the young republic. Abraham Lincoln's second inaugural address, delivered as the Civil War was ending, was remarkably free of triumphalism or calls for revenge. Franklin Roosevelt's fireside chats were effective not because they promised easy solutions, but because they conveyed a sense that someone was calmly thinking through difficult problems. In each case, the leader's tone communicated something important about American character, that we don't panic under pressure, that we can face difficult truths without losing our sense of purpose, that we're capable of making hard decisions without losing our humanity. President Trump's measured delivery of the tariff announcement may have been intended simply as a straightforward policy communication. But in the context of heightened national tension, it inevitably became a symbol of something larger, either reassuring competence or worrying detachment, depending on the observer's existing expectations and anxieties. Leadership signals are like lighthouse beams. Sometimes they illuminate, sometimes they confuse, but they're always noticed. This is one of the burdens of leadership in a democratic society. Every word, every gesture, every decision gets scrutinized for larger meaning. Leaders can't simply make policy choices based on technical merits. They also have to consider how their decisions will be interpreted by various audiences, how those interpretations will affect public confidence, and how changes in public confidence will feed back into policy effectiveness. It's a complex dance, and even experienced leaders sometimes struggle with it. What seems like clear communication to the speaker may seem threatening to some audiences and insufficient to others. What feels like decisive action to supporters may feel like dangerous overreach to opponents. You don't choose to become a symbol in moments like this. Circumstance chooses you. I think this is something that all presidents discover once they take office. They may have clear policy preferences and reasonable strategies for achieving them, but they quickly learn that their role extends far beyond policy implementation. They become symbols of national confidence, stability, and purpose in ways that no amount of preparation can fully anticipate. Some leaders embrace this symbolic role more naturally than others. Some find ways to use it effectively to build support for their policies. Others struggle with the weight of constantly being interpreted and reinterpreted by millions of people with different perspectives and expectations. But regardless of how individual leaders handle the symbolic dimension of their role, the role itself remains constant. In moments of national uncertainty, people look to their leaders not just for policy solutions, but for signals about whether the country is still capable of solving its problems through its established institutions and processes. That's both a tremendous responsibility and a tremendous opportunity. Leaders who can project competence and stability during difficult moments often find that they can accomplish more than would have seemed possible based on their formal powers alone. But leaders who project uncertainty or instability often discover that their policy initiatives face much more resistance than they anticipated. At the end of the day, this viral moment resonated because America is in one of those reflective periods, one where people are asking big questions about stability, direction, and the shape of the future. Every generation faces these moments of national introspection. I've lived through several of them now, and they share certain characteristics. There's usually a sense that the old ways of doing things aren't working as well as they used to. There's often disagreement about what should replace them. And there's always some anxiety about whether the country will be able to navigate the transition successfully. What's different about the current moment is the speed at which information travels and opinions form. In previous eras, these periods of national reflection might unfold over years or decades, giving people time to gradually adjust their expectations and develop new approaches. Now, the entire cycle of anxiety, interpretation, and reaction can happen in hours or days, creating a kind of emotional whiplash that makes calm analysis more difficult. Social media amplifies every signal and multiplies every concern. A policy announcement that might once have been debated in congressional hearings and newspaper editorials now becomes the subject of millions of instant reactions, each building on the others to create a kind of collective emotional momentum that can overwhelm more measured analysis. This creates both opportunities and dangers. On the positive side, it means that good ideas can spread quickly and build support rapidly. On the negative side, it means that misunderstandings and overreactions can also spread quickly and create problems before they can be corrected. The key is learning to distinguish between the immediate emotional reactions and the underlying policy realities. Markets will continue to react dramatically to every announcement, but the long-term economic effects will depend on the actual implementation of policies and their interaction with existing economic forces. Whether tariffs rise or fall, whether the policy is wise or unwise, that will be debated, as it should be. But the country's long-term stability does not hinge on any single announcement. This is something I try to remind people whenever they ask me about current political or economic events. Individual policies matter, and individual leaders matter, but no single decision or single person determines the trajectory of a country as large and diverse as America. Our economic system is incredibly complex, with millions of businesses, hundreds of millions of workers, and countless institutions, all interacting in ways that no one person can fully understand or control. That complexity creates resilience. When one part of the system faces problems, other parts can often compensate. Our political system is similarly complex and resilient. Power is divided among multiple branches of government, multiple levels of government, and multiple political parties. This creates inefficiency and frustration, but it also creates stability by making it difficult for any single person or group to make dramatic changes without broad support. Our social system, the networks of families, communities, churches, schools, and voluntary associations that actually hold the country together is the most complex and resilient of all. These relationships operate largely outside of politics and economics, but they provide the foundation that makes both political and economic cooperation possible. When people worry about American decline or institutional failure, they're usually focusing on the most visible parts of the system, the politicians, the headlines, the market movements, but the most important parts of the system are often the least visible. The millions of people who go to work every day, raise their children, help their neighbors, and maintain their communities regardless of what's happening in Washington or on Wall Street. Institutions endure because millions of people quietly do their jobs. The Constitution remains the anchor because generations before us insisted that it be one. Confidence returns because it always has, slowly, steadily, like dawn after a long night. I think this is the most important lesson I've learned from 9 decades of American life. The country's strength doesn't come from its leaders or its policies, though both matter. It comes from the accumulated decisions of millions of ordinary people who choose to invest their time, energy, and resources in building something larger than themselves. When I started investing in 1942, I was betting not on any particular company or any particular leader, but on the fundamental proposition that Americans would continue to find ways to create value for each other through voluntary cooperation. That bet has paid off beyond anything I could have imagined at the time, not because I was particularly smart, but because I was right about American character. The same fundamental proposition still holds true today. Americans are still innovating, still starting businesses, still educating their children, still building communities. The specific forms of that innovation and construction change over time, but the underlying drive to improve conditions for themselves and their families remains constant. Political leaders come and go, economic cycles rise and fall, but that underlying drive for improvement and cooperation is what makes America work, and it's much more durable than any particular policy or any particular administration. So when these viral storms hit, I tend to remember something simple. The foundation still holds. Quiet commitment is stronger than spectacle, and in uncertain times, steadiness is leadership. These aren't just platitudes, they're conclusions based on careful observation of how the country has actually behaved during previous periods of uncertainty and change. Time and again, when the noise dies down and the immediate crisis passes, you discover that the fundamental mechanisms of American society have continued to function. Schools have continued to educate children. Businesses have continued to serve customers. Researchers have continued to expand human knowledge. Artists have continued to create beauty. Neighbors have continued to help each other through difficulties. None of this happens automatically, and it all requires constant maintenance and renewal. But it also doesn't depend on perfect leadership or perfect policies. It depends on millions of people making individual decisions to uphold their responsibilities and contribute to the common good. That's been true for over 2 centuries now, through wars and depressions, social upheavals and technological revolutions, political scandals and economic crises. There's no reason to think it will stop being true now. The viral moment around the tariff announcement will fade from memory, just like countless similar moments have faded before it. But the underlying strength of American institutions and American character will remain, because they're based on something deeper than any single policy decision or political statement. That's the real story. Not the daily drama of politics and markets, but the quiet persistence of a people who have repeatedly proven their ability to solve problems, overcome challenges, and build a better future for their children. And if you keep that perspective, if you focus on the foundation rather than the surface waves, then even moments of genuine uncertainty become opportunities to appreciate just how much we've built together and how much strength we still have available for whatever challenges lie ahead. That's what I've learned from a lifetime of watching America at its best and worst. The foundation still holds, and that makes all the difference.